Richard and Colm, thanks for joining us. Really appreciate your time. Maybe I'll kick off, Richard, an introduction to you. I'll come to you then, Colm, an introduction to you and how did you get involved in venture funding?
Yeah, thanks, Conor. Good morning, everyone, or good afternoon, should I say. Great to be here and good to see so many people on the call. So my background, I mean, I got the startup bug early. I went straight from college. I'm an engineer, worked with a medtech startup, went straight to Sweden and worked with a couple of medtech startups as a techie and then in business development. So I kind of started out working with startups, and then later in my career, I moved to a multinational Intel, and I've realized fairly quickly, I was there for 4 years, that I missed startups and just, didn't like the whole being a small cog in a big wheel side of things, and missed ironically, going into a big high-tech company, missed all the innovation and the multifaceted, I suppose, elements of all the hands on deck in a startup. So I figured I wanted to go back to startups and always had the kind of sort of investment interest as well. So I thought venture capital would be a good way to go back to working with a bunch of interesting startups. So I did an MBA in the UK and worked for a VC in Newcastle for a few years, and then came back here and quickly met with Dublin BIC and came on board managing. At the time, we were managing the AIBC Capital Fund, which was the most active early stage tech fund in the market at the time. And then sort of since then, we stopped investing in new companies up to 2015, set about raising a new fund, which we launched in the market just over a year ago, which we can talk to you about today, in Smart Tech Fund. So yeah, I've been investing in tech companies for about 15 years now, and I'm sure many of you here will be coming to us, or I recognize some of the names I've already met in relation to funding. So look forward to the discussion today.
Fantastic. Thanks, Richard. Same question to you, Colm. You're more recently involved with DBIC Ventures over the last 12 months or so. A little bit about your background.
Yeah, sure. And I suppose you could say I've worked my way back into the venture world a little bit. I've been working as an investor my whole career. I've started off more in the later stage side of things in private equity for the first 5 or 6 years. There I was sort of working with new technologies, but not investing in tech companies per se. So it was more sort of taking new technologies and building up companies that were utilizing those sorts of technologies. More from a private equity angle, sort of made the switch onto the venture side through Series A and beyond about 3 years ago. Investing in companies focused on sort of decarbonization as a theme on a global basis. I spent all this time actually over in London. So I was over in London for the best part of a decade, and sort of, as you mentioned there, Conor, sort of got involved with DBIC Ventures last year after I made the move back home.
Great. Good to have you back and good to have you with us, Colm. Can I throw it out firstly? So we've lots of entrepreneurs with us. I think what they want to know is give us a little bit of background on the fund, size of the fund. What are you typically interested in? What sectors are you looking at? What stage are you investing? Maybe paint a picture between. I'll start with you, Colm, if I may, and just paint a picture of the fund and some background detail on what it is you're looking for.
Yeah, so the fund is, the ambition is to get it north of 30 million. And what we do with the fund is we're investing in companies that seed the Series A stages. With 2 main areas of focus that we're investing in. The main thrust of the fund is B2B software companies across a whole range of industry verticals. The other thing that we do is medical devices would be a subset of our deal. So the ambition of the fund is to invest 6-7 companies every year for the next few years and build up a portfolio of about 30 companies. I think a key aspect of the fund as well is that we can invest quite a bit in any one company over time. So we have a clear strategy of being able to follow on in the companies that we invest in, which is very important when companies are raising early money, that they have investors around the table that can be supportive throughout the journey.
Okay, Richard, can I turn to you and can I ask you, talk to me about round size, putting the round together, who else is coming in, and maybe you might just reference kind of 1 or 2 of the deals that you've already publicly announced and talk a little bit about the deal structure that underpinned those.
Yeah, no, thanks, Conor. I mean, the range from the fund in a first round, our range is typically 200 to 650K. The average is probably 350. We are seed to Series A, so companies that are a bit further on, so the small size Series A rounds, you know, we can invest up to sort of 650K. The typical round sizes that we'd invest in would be for a seed round, 500K would be at the low end, really, up to sort of 2 million on average, sometimes higher, you know, especially if it's a medical device company. So, you know, round size is probably the average round size for a seed kind of software company is sort of in the 750K would be a good average, but, you know, the range can vary quite a bit. You know, we always like to co-invest. So, you know, with our previous fund, all the deals we did, we co-invested with Enterprise Ireland. So they'd be a typical kind of co-investor. And then we co-invest alongside other funds, business angels, you know, Dublin BIC manage HBAN. So, you know, we work closely with a range of the different business angel syndicates, and then often just private investors, you know, not regular angel investors. So really a mix of EI, angels, privates, other funds, and the odd time sometimes there may be a strategic in there as well. And we often lead the round, but we don't have to. We can co-lead, or we can come in alongside perhaps say another fund that has already met the company and given a term sheet, and you know we like the deal. And then, you know, we can follow on up to 2.5 million in any one company. On, you know, that's really our strategy, as Colm was saying. And in terms of I suppose the first two deals we've done from the fund were in Evercam and Spire Software Solutions, two companies at different stages. One we would call a pre-Series A round, and Evercam, they're a company that, you know, are much further on than the majority of companies that we would be looking to invest in. They hit 2 million in revenue last year. So we co-invested with Elkstone in that deal, and a private investor. And then with Spire, actually, it was just ourselves and Enterprise Ireland in that. That was an earlier stage round. And we're sort of in legals now in another deal where it's ourselves alongside the Bloom Syndicate, which are part of HBAN, and Enterprise Ireland. And that round is about 800K, you know. So our average check size is 350, but the range is sort of 200 to 650, depending on the overall round size and the stage of the company.
And am I getting a sense, Richard, that there's a kind of a number of parties come together in the deals that you're doing? Are you leading the deal? Are you leading the round and kind of herding the rest of the people along? Or kind of how's the I suppose what I'm trying to get to is the process of actually closing that deal. What does that look like?
Yeah, the deal we're working on at the moment with HBAN, I'd say we're co-leading. We've sort of met the company at a similar stage, and you know, we've done kind of a term sheet that dovetails. So we're coming in on the same terms. And it works quite well. You know, it would be kind of a collaborative type of co-investment where we share due diligence. That makes life easier for ourselves and for the company as well. So the process, I mean, there are a number of deals where we're looking at where, you know, there isn't, we're probably talking to companies earlier than some other investor groups, and we'd be sort of leading on the due diligence. So it really depends on the deal. But the ones we've done so far, you know, Evercam, we really co-led with Elkstone. And the deals I referred to there were sort of, I suppose, we're the only fund, but Bloom are a fairly sophisticated angel group, done plenty of deals, so it's really kind of a co-lead on that deal.
Okay, Colm, coming to you and just picking up on your investments in Evercam and Spire that Richard has mentioned there, and you've obviously more in the pipeline. Why did you choose to invest? And I'm after the X factor for our participants on the call. What was it that made you consider, yeah, this is something we want to get into in broad strokes?
Yeah, I mean, I think there's a few sort of key core factors there. I mean, sort of team, I would say, is sort of always first and foremost for us. I mean, if you look at Evercam, I mean, you've two co-founders that we've worked together previously in the past and have had success. You know, demonstration of the product market fit, traction with the customers, obviously the size of the market opportunity. Those are all really the key parameters. I'd say in any deal, of course, as well, that, you know, striking that deal itself and the terms are always important as well. Key component to any transaction. But you know, main things is sort of, you know, the team, size of the opportunity, demonstration of product market fit, interest from customers, etc.
Okay, I'm going to pick you up on team there because we did get a couple of questions in, and there's probably two there, one from Paul O'Connor and one from Kieran McGarry, and they were kind of a question: would a VC firm fund a company with just a founder and co-founder, or does it need to be bigger? And then the second to Kieran, his question was: is it essential to have a full-time co-founder on board to get a better chance at getting investment? So I suppose just dig, if you will, Colm, a little bit into kind of team and what you see as the requirements.
Yeah. I mean, I suppose to come back on those points, which I guess are asking the same question in terms of single founder type companies. I mean, you know, VCs tend not to like that so much. I wouldn't say there's a hard and fast rule that's you know, that's a straight no. But the rationale there tends to be that, you know, we're looking for teams, you know, that complement each other, that have a balance of skill sets and personalities, and sort of single founder companies. You know, it's just sort of all your eggs in one basket, so to speak. So sort of it is important to have more than one or you know, names and frames and a view to bringing in more people into the company as well as it progresses. I wouldn't say that it's a straight no if it's a single founder, but I think there has to be an appreciation that, you know, it takes a team to build a company.
So you know, coming to you, Richard, with one founder, potentially a difficulty. However, talking about the kind of the gaps that you have in the team, talking about how you're going to plug them, how you might use the investment, does that kind of address somewhat the question?
Yeah, I mean, I suppose the cap table has to be right as well. So I suppose the challenge, you know, continuing on from Colin's point, if you just have a single founder and all eggs in one basket, there could be a problem with the cap table. So we do see a lot of companies that have outsourced, you know, a lot of their R&D, and it's, you know, often single founder, and then parachuting in a CTO after the round, you know, that maybe hasn't developed the software and doesn't really have enough equity in the company. And so that can be one of the challenges with a single founder company. In terms of, like, we don't expect all the co-founders to be full-time, you know, when they're fundraising. We know that people have to, you know, pay bills, and we see a lot of companies that are bootstrapped and co-founders have continued, you know, doing consulting work or doing some other work to bring in money while they're bootstrapping the company. But certainly after the round, you know, we do want to see, you know, that complementarity. I mean, the team might only be 2 people, and you know, it's really going from there. But we certainly want to see that complementarity from the outset, and then, you know, key hires. You know, we look for a good kind of commercial CEO and a CTO at the time of investment, and then key hires would often be, you know, bringing on a sales and marketing or a commercial director, and provision in the cap table, you know, good ESOP in place to incentivize new team members.
How much would you leave aside in the ESOP, just as a kind of a broad thrust, Richard?
I mean, generally, you know, the ESOP, I mean, it depends, but generally the ESOP we look for would be 10%, you know, as a minimum. 10% is kind of an average, I guess, actually. The deal we're looking at the moment, actually, the ESOP we're allowing is that's going in place is slightly below 10%, which is unusual. But actually, this is a company, the deal we're working on at the moment, where there's 3 co-founders. They're all very complementary to one another, you know, commercially and technically, and sales and marketing. And so the cap table there, actually, you've got sort of 3 kind of key positions filled by the co-founders. So there's less need for provision for, you know, there will be, of course, future key hires, but, you know, there isn't that sales and marketing director hire soon after the seed round that would take up a chunk of the ESOP.
Okay. I'm going to stick with you, Richard, and with a cracking question in from Ernesto, Dr. Ernesto Diaz Aviles, if I've pronounced that right, Ernesto. And it's around the process that companies go through when pitching to funds. And his question is, why are investors in Ireland so slow in making investment decisions compared to the US? You know, weeks in the US, maybe several months on this side of the Atlantic. This side needs a bulky business plan. On the other side, it's a kind of a one-pager. So I think what he's drawing is maybe a comparison between this notion of the fast investment process, yes, no, on one side of the Atlantic, and a much slower process here. Maybe talk about your process and how you manage the funnel of investment from, you know, how does somebody come to you and how do you work your way through that process?
We do try to be very responsive, and it's a good point. I mean, certainly we want more than a one-page summary. We don't always see business plans, but what we expect to see is initially is an investor deck. And if we're interested, then the key things we ask for after that for most businesses will be a more detailed deck, which would effectively be like a business plan, but it doesn't have to be a 40-page Word document. It just needs to cover all the key elements of the business. I mean, effectively, we get more information though from the founders and actually in follow-on meetings. We'd also expect to see a financial model, after a first meeting and a sales pipeline. And the number of many companies don't have that ready. So I suppose that's one thing it's important to have ready when you're talking to investors. In terms of us, like we've had almost 320 inquiries to date. We're actually going through a very busy period at the moment. We have about 7 deals that are on the go at the moment. But I'd say, we are trying to be dynamic and move quickly. So if a company comes into us and we're interested and we feel like they're going to be able to put a round together in a reasonable time frame, we can move very quickly. The deal we're doing at the moment, I mean, we went from initial meeting to term sheet in a few weeks. So, we are being very responsive to the deals that we see that are ready. There's some that come to us where, they look interesting, but they're a little bit early, or, they're looking to raise a 2 million round and they're only starting the process, in which case there's no point in us going really, really fast because we know it's going to take them time. They may not have fully engaged with EI. So our process, like we are, many of us have worked in startups before and raised VC. We've been on the other side, and we like to be pragmatic and unbureaucratic. So, we're very approachable. We typically try to set up calls within a week or two, an inquiry coming in. As I said, at the moment, we're very busy, but, we're still trying to accommodate fit kind of companies in sooner rather than later. And I suppose the key thing is if a company's too early, we do try to sort of give that feedback and say, come back when you've done X, Y, and Z, or if it's not a fit for the fund, so we don't waste people's time. But our process, like we have an internal investment committee with, I suppose, one independent member. We're not as kind of regimented as maybe some other funds that maybe only have, they have committee meetings once a month, or, if you go through Enterprise Ireland, obviously they're a big funnel and they have committee meetings every 2 weeks. So look, we try to be responsive. We move quickly and try to be pragmatic, but it depends on the volume of activity that's going on at the moment. As I said, we have about 7 deals on the go at the moment.
And typically from your side, how long does that process take? Are you seeing, if you reflect on kind of maybe an Evercam Aspire, or indeed the deal you're working on now, what sort of time frame is it taking from I met you, I sent you in a note, Richard, to we've done the deal and you've invested? What's broadly that looking like?
Well, the first 2 deals, the legals went on much longer, and in fact, the delays were due to, I suppose, a bit of advice to all companies out there raising funding. The best thing you can do is make sure you have a seasoned legal team that are used to doing early stage transactions, because that can make a huge difference, and that can slow deals down. The deal we're doing at the moment, we've been very responsive. I mean, the deal should have actually closed by now, but there's other stuff. The company's very busy, and it is a big distraction for management teams. So, the timelines, I mean, there's no reason why, if everything wasn't ready and there were co-investors in a round lined up, that a deal couldn't happen within a couple of months. But I suppose the law of averages, because there's a number of moving parts. Enterprise Ireland are often in the process. It can take up to 6 months. I mean, it shouldn't take that long. And we have done, in our previous fund, we've done deals in sort of 5-6 weeks in some cases. But sometimes there's something that comes along that slows it up. I suppose our mantra, when we're doing a deal, we try to be very quick and responsive. So I got to say that I suppose that we haven't been the bottleneck in sort of the speed of execution with the deals that are going on at the moment, or the ones that have been completed.
Okay. I see a question from Gareth. I'm going to come to that in a minute, Gareth, because we are going to have just a session on kind of valuations and equity. Colm, if I could come to you, and we got 2 questions in from Sarah Marie Rust and Elaine Bugle, and they were talking around what's on your checklist. What do you want to see when companies come to you in terms of revenue, customers, and then Elaine was saying, what are the key factors you're looking for from the startup? So the startup comes and sits in front of you, Colm. What are you looking for? What's making that decision process easier?
Yeah. Not to be a broken record, but sort of, I suppose team again is sort of first and foremost. I guess beyond that, when it gets into sort of metrics and stuff, and how would you define if we say we're seed to Series A? Like what does that mean? We tend to look for sort of minimum initial revenues from the market as demonstration of product market fit and demand from customers. But I would say that we look at everything on a case by case basis. So there's no, we're not a bank with a checklist to say that you have to have this level of euros per month for 3 months or anything like that. I think important considerations as well as sort of how long has it taken a startup to achieve certain milestones and certain goals. I mean, if you're talking about getting to say 10K a month of revenue, has that taken 12 months or has somebody done that in 12 weeks? And obviously if someone does that in a very short period of time, that's more impressive then as well. I would say beyond those sorts of metrics as well, like very rounded thinking always is very impressive. And I say that in the sense of not just about the solution or the product, but also the go-to-market strategy, the hiring plan, all these other aspects that need to be well thought through for companies to be successful. In my experience, a lot of the drags on scaling up and achieving the success is sort of not having that rounded thinking and rounded approach, and stuff just taking a bit longer because there was just too much focus per se on the product and sort of thinking that everything else would just kind of fall into place after that. And then you realize that you really have to build out a proper sales and marketing function, go-to-market strategy, etc. So people who have done that and they come to us and demonstrating that depth of thought in all those areas, I guess that's what really would stand out to me.
Thanks, Colm. And the other side of that, which was I think Sarah Marie's question, the other part of that is, what's the reason that startups fail during an investor meeting? What's the kind of no-no for you where you kind of say, oh no? Is there anything that springs to mind that makes you immediately say, this ain't going to be for us?
Yeah, I mean, I suppose, like assuming that the startup and the activity is sort of within our scope or within our strategy, I would say, in a sentence, probably a lack of coherence, whether that's sort of stuff that's a bit out of sync or not thought through enough, or just kind of a little bit, testing the waters a little bit, not sort of has somebody really identified something, shown expertise, shown a depth of understanding of the marketplace that there is a product out there.
Market size,
team as well as I keep coming back to team, but I mean, if you see any sort of dysfunction within the team or potential lack of alignment and stuff like that as well there, that can also be something.
Do you see market size as in, I've pitched you a market size of X million and you just think it just isn't big enough for us, there's no scale in that? Potentially,
but less often, I would say, to be honest. I mean, provided that it's a business model that can scale. I mean, whether it's a 500 million market or a 5 billion market doesn't tend to swing things too much in my mind if you have a scalable business model that can capture a good chunk of that market. And if someone can demonstrate depth of knowledge within that market and a credible pathway, to success in that market. So, I would say sort of niche markets are not necessarily showstoppers in that sense.
Okay. Richard, moving to you, can I pick up valuations? Garrett had a question there on the average equity stake taken by the fund for the average seed fund. So we're talking in the abstract here, but also we had some questions in from Patrick and from Alan, and they were kind of asking the same thing. So maybe paint a picture of the valuation model for the early stage startup and typically what's that looking like? Now, I know there's individual cases, but paint a broad picture if you could for me.
Yeah, I mean, obviously it's a function of the stage of the company, the level of risk, whether the company's raised money before, the size of the funding round, that all those things feed into the valuation. I mean, for a seed round, the typical dilution that you would see in a seed round would be sort of 20 to 35% in total. Anything kind of higher than that, anything more than a third is getting quite dilutive and nobody wants that. And that's not the equity stake from the fund now. As I said, we always co-invest, so that would be the entirety of the round. So, we do see kind of, obviously you see on Dragon's Den where they offer them money and they look to take 50% of the company. We never do that because, we want management to be aligned, and we know that there's a journey ahead and there's going to be future funding rounds, mainly for most companies that are successful. There are some outliers where they're acquired after a first round, but they're the exception. So in terms of the fund equity stake, I mean, depending on our level of participation in a round, the stage of the company would typically be between sort of 5 and 15% would be the equity range that we would look to take. We're not massively hung up on what that figure is. Obviously, the key thing for us is that our investment has to have the potential, and I say potential, to deliver a 10x return for our investment. So the valuation does feed into that. So in other words, if we're going into a company at a pre-money of, or say the post-money, the round is 5 million, and there isn't any follow-on funding requirement, which is unusual, we'd want to see potential that company could exit for 50 million plus. And that seems kind of, I know that seems like a very high expectation, but the reality is we're investing in risk, and that's our job. And we'll invest in 30 companies or so. And most, there'll be a third where we lose our money, a third where we get our money back just about, or plus or minus a little bit, and then a third that give us a multiple. But of the top 10, there may only be 1 or 2 that actually end up giving us the double-digit returns that we saw the potential for it from the outset. So valuations, if somebody's raising a bigger round, the valuation might, and they get interest and the round becomes oversubscribed, the valuation might go up a little bit because the dilutive effect of that round would be too much. We have had companies that we've invested in before where, the management team maybe haven't had enough equity when we came in, and they went through a number of rounds and got diluted down to sort of below 10%. And that's not good. So, sorry, that's a long-winded answer.
So, but broadly, if I were on the call, picking up your point there about at the seed round, it's going to be somewhere between 20 and 35. Mostly it's below 30, but somewhere in that range is kind of what's been given away on a first seed round. And the valuation is a function of arriving at that as a kind of a percentage that you as the investor want to take maybe in the first round, leaving enough incentive for the promoters to kind of grow the business.
That's right. Yeah. So, I mean, for like a software company at an early stage, say raising a 750K round, I mean, there's no hard and fast rules, but valuations would typically be sort of 1.75 million up to, 3.5 million, depending on the stage of the company. And then, slightly larger rounds where the company is a bit further on, the valuations could be higher. A lot of medtech deals, where the round size is sort of 1.5 to 2 million, you might see pre-monies of 4.5 million thereabouts, and then you end up at that kind of level of dilution.
Okay. Colm, moving back to you. So I was just on a call with Julian from the HBAN network, and he was saying that his sense was that there was quite a good bit of availability of, he was talking about the pitching that he's running at the moment, it's all moved online, and that he thought that there was great interest in the pitch process. There was certainly money available. I suppose my question is, what's the investment landscape looking like at the moment for kind of that early stage seed rounding? Is there money available? And what's your sense on that?
Yeah, I think there is money available. I mean, I think, for really good prospects, we're seeing rounds that are oversubscribed. So obviously each circumstance is different, and each raise is different, but for good companies, with great prospects, we're seeing rounds that are oversubscribed, and competition in the market to invest in those companies. So I think if you step back and look at the environment, I think it actually is quite, notwithstanding a lot of the challenges that we're collectively facing at the moment, it's quite an exciting time for entrepreneurs and startup activity, given the degree of change and stuff that's going on just on a macro level, which is potentially feeding into some of that. So these sorts of unusual times tend to be good opportunities for startup activity. I think part of that is feeding through at the moment.
Yeah, and picking that point up, then, Richard, I suppose, you know, we have been in a very societally difficult place for the last 12 months, but from that, their opportunities are arising. And what are you seeing over the next 12 to 18 months in terms of trends, in terms of changes that are happening across the startup landscape?
Yeah, I mean, clearly there is kind of an increased emphasis on sort of digital transformation and the smart automation. You know, I suppose if you look at our second investment, Inspire, that's basically they've developed software for the vehicle recovery operator industry. Think of when you break down on the side of the road, and they've been kind of using the same tech there for the last 15, 20 years, all operators across the globe, which comprises of phone calls and email primarily to dispatch vehicles. Inspire have kind of developed a sort of, if you think of the Halo or Uber type experience, or iCabby for those who know iCabby, using smart automation and smart dispatch technology to really improve efficiencies. So we're seeing a lot of stuff around sort of digital transformation for businesses across lots of different sectors. We're seeing kind of omni or multi-cloud being a big thing as well. Customer data platforms aggregating, you know, for e-commerce businesses, aggregating customer data and using that to make more informed marketing decisions and improve conversions. You know, cybersecurity is obviously going to, you know, the world we live in now with cybercrime on the increase, and I suppose more businesses moving to digital solutions, they're more exposed. So we're seeing more in that space as well. Although a lot of cyber tech companies require quite a bit of capital, and the sales cycles can be longer. Digital health, you know, I mean, that's always been there, but the pandemic has definitely been a catalyst for that. Yeah. Fintech as well is, I suppose, a sector that we're seeing a lot of deal flow in, and expect to see kind of continued deal flow in that area. So we're seeing kind of activity across a range of sectors, but I'd say digital transformation and, you know, just smart automation and XaaS, which is kind of anything as a service now beyond just software as a service.
Okay. I'm going to pick up some of the questions in the chat there, if I may. Colm, there's one there around, it came from Oana Ruska, and it was around SAFE as an investment mechanism, I think pioneered by the Y Combinator guys. Is that something that's kind of over this side of the water?
We have seen some companies looking to raise using sort of, you know, just convertible notes in general, following that format. I mean, it tends to be something that we tend not to look at, or it wouldn't be our preferred structure. I mean, I think it's, you know, it's primarily created for private investors who weren't as used to pricing rounds versus traditional or professional venture capital firms like ourselves. And it's, you know, in my own view anyway, it creates a little bit of a misalignment in the cap structure, because you sort of, in the next round, you as the investor, you sort of want a low price so that you convert at a lower valuation. Whereas if you come in on a price round at the seed stage, you know, you complete alignment across the cap table between yourselves and founders in terms of increasing the valuation at the next time the company raises money. So we tend to see notes like that more useful in sort of, you know, if there's a bridging round that we don't want to price, just if a company needs a small bit more runway to reach an inflection point or something like that, and let a new external investor price the next round.
Okay, thanks, Colm. Richard, can I ask you about IP? So there's a question there from Tom around, do you need it legally ring-fenced before you're interested in talking? What's your sense on that?
So IP, intellectual property rights, no, I mean, so depending on the company, intellectual property, is that what the question was in relation to? You?
Yes, yeah. IP. Yeah.
So we don't expect to see any intellectual property rights beyond copyright for most software companies. You know, most software companies we see, you know, it's probably pointless trying to get a patent. They're hosted in the cloud, and the defensibility is the know-how and the code, and having sort of maybe early mover advantage. It's different if you're a medical device company and you've developed a piece of hardware or diagnostic system that is improved over, you know, radically improved over existing devices on the market, that could be open to be copied. Different than software, where software typically is hosted and nobody can interrogate the software. It's in the cloud. So yeah, I mean, if we're looking at a number of medical device deals at the moment, and we'd be looking very closely at the patent applications, or the PCT, depending on the stage they're at. So for software companies, by and large, it's not something we look for at all, really. There are exceptions where it might be some piece of deep tech software that's come out of university, and there's very complex algorithms that are really a new way of doing something that could be protected, but it's not something that we really look for.
Okay. Can I just stick with you for a moment, Richard, on, you mentioned Spinouts and kind of that whole deep tech area. Is that a separate kind of stream of activity? Because presumably the Spinout, particularly around deep tech and things, has a longer kind of gestation period, if you will. So is your investment thesis different when looking at kind of Spinouts than it would be maybe for kind of the software products that we see as a standard?
Yeah, I mean, for Spinouts, we invest in revenue generating and pre-revenue companies as well. And, by and large, most spin-out companies will be pre-revenue at the stage that they raise investment. So the inflection points could be different. I mean, if it's a medical device company, the inflection points would often be getting to regulatory approval or, completing a trial. So that would be, we look at those quite differently. We're really looking at obviously there has to be a sales and marketing plan beyond that, but most of the focus is actually on the R&D, the regulatory pathway. The funding risk is, and the team to execute. It's a different focus than if we were looking at a software company. We do go into software companies that are pre-revenue as well, but by and large, most of them are kind of at early revenue generation stage. We're doing 2 deals at the moment where, I suppose to Colin's point there, when asked about, what do we look for? There are 2 software deals we're looking at the moment that are pre-revenue. They're not spinouts, they're pre-revenue, but they're very compelling because the 2 companies have managed to build up very good pipelines in a short period of time and have very good momentum. So for spin-out companies, generally they're pre-revenue, and we're looking at slightly different things. For revenue generating companies, we're really looking at the unit economics in terms of the traction to date, the sales cycle, the pipeline. That's where the focus is, in addition to, of course, the team.
Okay. We've about 5 or 6 minutes left. Colm, I'm going to come to you. Bilal has sent in a question there, which I think is kind of typical of the very early stage startup. So he's kind of saying, I'm in a catch-22. I approach investors, they look for a product or an MVP, but for me to get that functional MVP, I need investment. So it's your typical early stage quandary. And there's lots of early stage supports around in Ireland, particularly driven from Enterprise Ireland. So what's your sense on that, or what advice would you have for that, for Bilal, but more generally for the early stage startup around moving through that really early stage of building an MVP, getting some customer traction?
Yeah, I mean, it's fair to say that, there is that issue at times, and it's right to acknowledge that. As you mentioned, Conor, I mean, I think there are a lot of sort of supports out there for stuff like that. Earlier stage capital than ourselves. I think as well, I mean, when you asked me earlier about like what would be impressive and stuff, I think in circumstances like that where someone is very resourceful, and we've seen instances of entrepreneurs like that who've been able to get grant money here and there, or they've found someone who's a bit of an expert in the space to give them a little bit of time and all the rest of it, and sort of going beyond just bootstrapping and being very resourceful. That can also be very impressive. But yeah, it can be problematic at times.
Just to add to that, I mean, we do see a lot of kind of people that are working their day jobs, and they're they're paying for outsourced development to some third party. And my advice would be find a tech co-founder early on and really it is bootstrapping, and you actually have a team there that have equity in the company that are actually developing that MVP. You're not having to pay a third party to do that. And if you're a really high-tech company or a medical device company, I think to develop an MVP outside of kind of getting grant funding is very difficult. I mean, most of the sort of hardware medtech companies we're investing in have already raised 500,000 or so in Enterprise Ireland commercialization funding and SFI funding. So sometimes, if it's very deep tech and you need, there's a long R&D cycle to get to an MVP, spinning into a university is an option as well.
Okay. Can I go back then for probably our last question or two? I'll hand this to you, Richard. Marketplace. So there's a conversation, or there's a question there around your view on marketplaces, and are they considered for pre-seed or indeed for seed rounds? And what's the general sense on the appetite for investment into that marketplace type company?
We probably would have seen more marketplaces a couple of years ago, and I know, like I think EI for a while, we're maybe pushing back. They were seeing an awful lot of marketplace opportunities. I wouldn't say we wouldn't invest in marketplaces. We did actually before their previous fund. We invested in Online Tradesman, which is a marketplace. I suppose for us, I suppose what we look for, and the challenges with a marketplace is really building up both sides. You're not just having to onboard customers on one side, but you're having to get the supply side right as well. So getting that balance can be challenging, and how you scale that. I suppose that's one thing we'd like to see. And then also defensibility as well. What makes you unique, or is it easy for somebody else to come along and replicate it? So I wouldn't say that we won't invest in marketplaces, but we would look for, very compelling plan in terms of how it's going to scale on both sides. Because if you have a marketplace and it's out of sync, you have too many suppliers, not enough buyers, then the suppliers get fed up. And if you have too many buyers and not enough suppliers, then buyers don't get what they want. So it's, so there's that, and then just defensibility of, what is your secret sauce? Have you got something special that's going to help you to scale?
Yes. Yeah. Understood. We've about a minute or two left. I'm going to come to each of you. Colm, I'm going to start with you. So your piece of closing advice for the participants on the call, they want to come chat to you. They want to pitch it to you. What's going to get your attention? I
would say, practically speaking, before coming to pitch to anybody, is to do homework on VCs and investors. I mean, there's a lot of good resource out there in terms of, people tend to put their strategy. So understanding that very well, I think that's quite practical in terms of like what to present and here's the cover. I think I touched on earlier, sort of having a very holistic and well thought through process, covering all the key areas, having a balance, and just something that displays the understanding of the sector, why credible differentiation and credible sort of planning as well, as to when someone's saying, well, I need funding for this, okay, it needs to, what's that going to achieve? Is that credible? Is that going to give you enough time to do that, etc., etc.?
Okay. Last word to you, Richard. What's your advice?
I mean, we'd like to see all those things that Colm said. I suppose here the advice then, if you get in front of us, we have met, as I said, 320 companies or so far, and there's some that aren't a fit, and then there's some that are just too early, or we want to see some other proof points. So I suppose if an investor says you're too early or no, ask them, if we did this, or what would you like to see? What's your feedback? And, you will hear slightly different, you'll get different views of the world from different investors. So you just have to form your own view of the world. But I think don't leave a meeting without asking, well, if we did X, Y, and Z, or, what would you want to see? So I think that's probably the key bit of advice for me.
Make sure you don't leave wondering, leave with a very direct question as to what has to happen next. Where are you, the investor in this process, and what do I have to do?
Yeah.
Very good. Thank you, Richard, to Colm, and I see Sarav, the third member of the gang there. Hi, Sarav. Thank you for your time, for coming on this afternoon and talking to us. To you, the attendees, thanks for coming on. The guys are open for business. Please do follow back. If you want to follow back through Donna, it's startup@dublinbic.ie. Please do drop us a note. We'll put you in touch with the guys and do follow up. Thank you all for your time this afternoon, and we look forward to seeing you on our next investor call in a couple of months.